Welcome to the Weekly Option, the podcast for people interested in trading stock options. Each week, we cover trade ideas and opportunities in the stock market right now. Whether you're a beginner, a professional, or just curious about options, this is the show for you. Let's get started. Welcome to the Weekly Option. This is episode 67 on June 22nd, 2019. I'm your host, Eric, and in this week's show, we will cover the trades from last week on Coty Inc., United States Steel, and the S&P Oil and Gas Exploration and Production ETF. And we discussed three new trades on Qudian Inc., JD.com, and the iShares 20-year Treasury Bond ETF. Now, it's always great to hear from listeners. If you have any questions about the trades presented here on the show, or even about your own positions, feel free to email me. My email address is eric@theweeklyoption.com. That's ERIC at theweeklyoption.com. I've also created a short video series to teach you all the basics of option trading that you'll need to know to be able to follow along with me on this show. You can visit our website and click on the videos tab to watch them, or visit the YouTube channel for the Weekly Option. Now, the market had a nice move up this week with both equity indices finishing about 2% higher. The Dow Jones Industrial Average grew 629 points, ending the week at 26,719 points. The S&P 500 index finished 63 points higher, closing on Friday at 2,950 points. Now, we're going to dive into the topic of the week. The topic of the week is sponsored by The Option Studio. If you want to learn to trade options without any calculus and confusing language, visit the website to learn more about the online course. Visit www.theoptionstudio.com for more information. So the topic this week is keeping it simple. A lot of people have that, the acronym KISS, keep it simple, stupid, or keep it simple, silly, or whatever makes you happy. But at the end of the day, keeping it simple has been the key to me making money in the options market. It's easier. So the angle I'm taking on this one is that you can't be a pro at every type of option trade, right? It's easier to just start with one type of trade. Now, each week, this show talks about three different types of trades. We cover covered calls, credit spreads, and debit spreads. Truthfully, there are dozens more trades out there, trade types. I mean, straddles, strangles, you can get into butterflies, you can get into calendar spreads, you can get into all of these other things, putting on a fence or synthetic stock. You can look at collars, which is similar. You can do all sorts of things, and every which way you want to trade, there's an option trade out there for you. Some of them are really complex. Some of them are far more simple. But at the end of the day, if you focus on learning every type of option trade before you get into the option trading market, you'll actually never learn because all of your knowledge will only be academic. So regarding the show, even though I talk about three different types of trades each week, you don't have to put on all three or even focus on all three. Choose one type of trade that matches your risk profile. All that's important is that you find one or two ways to consistently make money in option trading. And if you focus on one type of trade to start, then you can learn what makes that trade, what factors make that trade work, what factors have led to losing money with that type of trade. You can actually become a pretty good professional at trading. Now, when I was on the trading floor at the CBOE, I remember there were specific trading groups that only traded one or two types of trades. One group only traded the roll, which is a type of trade when you're rolling risk from 1 month to the next, typically done right before expiration. They came in to facilitate that for the traders that intended to roll their positions, their risk from 1 month to the next. These time spreads only traded once a month. They wait until about a week before expiration, and then they would trade millions of dollars worth of that one type of trade. They didn't get distracted with all of the daily price movement in the weeks coming up to then. They didn't get caught up in news or listening to financial television markets and all of that. They had one focused plan, one set of rules they looked for, and it defined when they got in the market and what situations were most optimal for them. So if you can do the same thing. If you decide, if you really not just decide, but commit to learning one type of trade, you'll figure this game out. You'll figure out option trading. And once you're consistently making money with that type of trade, or at least understanding how to avoid losing money, then add the next one and then add another. And sure, if you take that on over a short amount of time, you'll be able to, you'll truly be a professional option trader. You'll understand markets as well as I do. And you can add all of the extra complexity too. There are a lot of things that can help you view risk and possibly adjust your trade positions that I don't talk about on the show because, quite frankly, they're too complex for this show. But they exist, and I don't always use them, but they're there, and I understand how to use them if I need to. If you focus on truly diving deep and learning one trade, and that's what I'm calling keeping it simple, you will become a consistent money earner in trading options. It's not magic, it's not that challenging. Most people decide, hey, I'm gonna get into option trading and I'm gonna buy this one option, and they get out there and they decide to buy some at the money or far out of the money option, and they decide they're going to buy, $2,000 worth. They're going to buy a lot of it, and then they lose that money, and they are resolved to the fact that the option market is too risky because every time they get involved, they lose money. Well, there's a reason they lost money, and part of it is because they didn't commit to learning the process. They just treated it like a lottery ticket. Stock options aren't a lottery ticket. It's simply mathematics. It's math and probability. And when the odds don't work in your favor, just as you hear on this show, you'll hear a lot today, there are other decisions you can make to try to minimize the loss so that you can decide how much you're actually going to lose or how much you gain. But that's it. And if I were to suggest a trade for you guys to get used to trading each week, I would say if you're starting out and you have a defined amount of risk capital that you can allocate towards learning options, I would say look at debit spreads. Debit spreads are great because you're buying the spread. You know from the start, because it's a spread, you know right off the bat how much money you can possibly make and how much you can possibly lose. So that's all defined right off the bat simply from the fact that it's a spread. And you'll be buying, so depending on the amount of capital in your account and the risk tolerance really of your brokerage, and I like using a couple brokers. Like my favorite right now is Tastyworks, but I'm a longtime user of Interactive Brokers as well. If you have a decent broker, then you can put up a little bit of money and trade small every week or once a month or whatever, and start to really figure out what makes money in this market. And debit spreads are great too, because if you look for pricing if you look for sort of my rules in pricing, I typically am getting close to 50% on debit spreads when they work. And if they don't work, it's okay because I know how much I could possibly lose. It's the amount of money that I paid for it. So that's it for the topic of the day. If you have any questions, again, email me. My email address is eric@theweeklyoption.com. That's eric@theweeklyoption.com. So we'll get into the trade review for this week. And with the market being higher this week, my trades did not fare well last week. I ended up being short, right? We were short a call spread and long a put spread, both of which are trade types that increase in value as the market falls, right? Being short a call spread and being long a put spread makes money when the markets go down. Markets were up about 2% this week, so let's get into putting salt in my wound. So we'll start with the covered call. Looked at Coty Inc., symbol COTY, Charles Oscar Thomas Yellow. At the time, the stock was trading for $13.58. We looked at buying that stock and selling the July 14 call at 50 cents, hoping for a 6.77% return in 5 weeks. Well, Coty stock fell 50 cents this week, ending at $13.08. Ironically, that is the exact break-even price that we needed for, or that we had for this trade, since we collected 50 cents when we sold this call option. So if we were to buy back the call option today, we would have to pay 31 cents, which is a gain of 19 cents on the option. But since we lost 50 cents on the stock, that would mean if you close the trade out, you'll be closing for a total loss of 31 cents because of the stock move. Today, the stock closed below the 20-day moving average, and the last time it did this, the stock rallied and continued the upward price trend after that. So since this is a July trade, we really don't have to make a quick movement to protect this trade. I would lean towards waiting for a few days, definitely waiting a few more days for price movement before closing this trade, or even before deciding to roll the strike lower. If we do drop below $13 a share, my next move, of course, you guys have seen it in the previous weeks, my next move would be to buy back the July call and then sell the new at-the-money call, which would be the July 13 call. Now, of course, these decisions all depend on your level of risk tolerance. So some people, it's like they give it a week. If it didn't make money in the week, they're going to exit. I look at this as July. This is a July trade. There are 4 more weeks left in July, or at least until July expiration. So that means I've got 4 weeks to turn this one into a winner. Our second trade, of course, is the credit spread. And we looked at United States Steel, symbol X, as in X-Men. Stock ended the week last week at $13.78. We were looking at selling that July 14-15 call spread at 37 cents, which could yield a maximum loss of 63 cents per spread. Well, United States Steel stock rose 89 cents this week, closing at $14.67. The out-of-the-money call spread we sold is now partially in the money, right? The stock is right in between our two strikes. The spread has increased in value to 57 cents, which yields a 20-cent loss for us. Now, you could certainly close this trade and take the 20-cent loss, or you can leave it open and enter another trade, and at least compensates you for the 20-cent loss. Or you can close the trade and roll it to a higher strike, or even just focus on selling a put spread instead. Now, I like selling a put spread against this call spread. That creates something called an iron condor, but it creates a price range where I can make money possibly on both trades, or I know right off the bat that my maximum loss would only be on one side of the trade. A put spread and a call spread can't, if you price it outright with the strikes, they won't both end up making money, right? They are costing you money. So I can sell the July 14-13 put spread against this call spread that I already have on, the July 14-15, and I know that only one of those will finish in the money. So if I sell that July 14-13 put spread, I'm actually going to collect 24 cents, and that reduces my overall maximum loss on the trade from 63 cents down to 39 cents. So right now we could still lose another 43 cents on the short call spread alone. Now, if you're not going to close it for the 20-cent loss, then definitely consider doing something. I'm looking at selling that put spread against the call spread. Now, of course, we just experienced June expiration, so and I'm going to say this later on the show as well, but the half strikes will open up soon as well, so you'll have more strikes that you could use in this trade. Our final trade from last week was the debit spread that we placed on the S&P Oil and Gas Exploration and Production ETF, symbol XOP, X-Ray Oscar Paul. Stock was trading for $24.96 at the time. We looked at buying the July 26-25 put spread, paying 60 cents, which could lead to a maximum gain of 40 cents or a 66% return in 5 weeks. Well, the S&P Oil and Gas E&P ETF rose $1.75 this week, finishing on Friday at $26.71. That completes a 3-for-3 loss on my trades this week, which kind of sucks. But the in-the-money put spread, which we purchased, fell 33 cents per spread, It's still early in the month of July, and most of you know that I don't like to lose money. So there's several trades we can make against this trade to limit or mitigate any further loss. So the stock price is down near the 10-year low in this stock. That means that it might be a good time to put on long trades. We can look to sell put spreads against our loss, along with closing out this long put spread position. There's still another 27 cents we could lose in this spread. So with stock higher, we are likely to lose all of that. You could sell the put spread and buy the July 26-27 call spread for 59 cents. That would give you a possible upside of 41 cents, and it would allow you to buy the spread under the current intrinsic value, which right now is 71 cents. So there's an intrinsic value, meaning that the in the money spread that you would be, the in the money call option you would be buying actually has 71 cents built into it right now because of the way that where the underlying shares are priced. And because we'd be selling that 27 call against it, we'd be able to buy that option essentially for 59 cents, even though it has 71 cents of intrinsic value. Now, I would look to sell the put spread, sell put spreads, but the downside spreads don't have a whole lot of premium in them right now. You could take a loss, of course, on this original put spread purchase and just walk away too. So sometimes walking away is the best thing to do. I actually am looking strongly at that call spread, mostly because of the possibility of buying something undervalued that already has 12 cents of intrinsic value built into it. And I'm taking that 12 cents because I'm saying it has 71 cents of intrinsic value and I'm only paying 59 cents for the spread today. That means that today I'm picking up 12 cents that's not priced into the market right now. So let's move into this week. Of course, yesterday, Friday, was June expiration. So all June option trades are now either priced at their intrinsic value with the stock or they're worth zero. They expired worthless. So on Monday, the 50-cent strikes will be priced at the exchange. So if you are dealing with a stock that normally has $1 wide strikes, you'll see the 50-cent wide strikes being priced in. So there may be some better trades available after the open on Monday. And that means that the trades that I'm discussing this week, I likely will not actually execute. And that's the way it is for every expiration. I'm going to take the same ideas for this week and look at their stock, look at each name and see if there's a better spread or a better value that I get from using the half strikes instead of the $1 wide strikes. So our covered call is on Qudian Inc. It's an ADR, which means it's a foreign country that is listed on the New York Stock Exchange. The symbol is QD, Queen, and David. The stock finished the week at $8.18, and I'm looking at buying that stock and selling the July 9 call at 25 cents. That yields a total return, if it's in the money, of 13% in 4 weeks. So you enter this trade by buying Qudian stock for $8.18 and then selling the July 9 call at 25 cents. This trade makes the most money if stock prices finish above $9 per share. And of course, the break-even price on this trade is $7.93. Next trade is going to be a credit spread on JD.com, symbol JD, John David. Stock ended the week at $29.06, and I'm looking at selling the July 29-28 put spread at 38 cents, which could yield a possible loss, a maximum possible loss of 62 cents per spread. Now you enter this trade by selling the July 29 put at $1.16 and then concurrently buying the July 28 put for 78 cents. This is a credit spread because we are selling the spread, and this trade makes the most money if stock prices stay above $29 per share. The break-even price on this is $28.62. And then our final trade on the week is going to be a debit spread. I'm looking at the iShares 20-year Treasury Bond ETF, symbol TLT, Thomas Larry Thomas. Stock ended the week at $131.43, and I'm looking at buying the July 130-131 call spread, paying 66 cents, which could yield a maximum gain of 34 cents per spread or 51% return on your money in 4 weeks. You entered this trade by buying the July 130 call for $2.26 and concurrently selling the July 131 call at $1.60. This is a debit spread because we are buying the spread, and this trade makes the most money if stock prices stay above $131 per share. The break-even price for this trade is $130.66. That's it for this week. I hope you guys enjoyed the show. Thank you for listening. Definitely share it with a friend, friends who like option trading or are interested in learning option trades. And I also love having people on my show who have, gotten burned trading options in the past, because typically with a little bit of information, a little education, you can learn how to make some money in this market. So that's it. Hopefully we'll see a few weeks of long trades, long stock movement. I like it when the stock market goes higher, and that certainly is what we need for this week's show, since we are short put spreads and long a call spread. So that's it. If you have any questions, email me. Otherwise, we'll see you on next week's show. Happy trading. Thank you for listening to the Weekly Option Podcast. Please subscribe to our show and visit us at www.theweeklyoption.com. Disclaimer: there is a very high degree of risk involved in trading. The indicators and strategies described in this podcast are for educational purposes only and should not be construed as investment advice. For our full disclaimer, visit our website at www.theweeklyoption.com.